Our guest looks at markets at all-time highs, but says we've got these weak job numbers in Canada and the US. However, she thinks interest rate cuts could push markets even higher, but she warns against becoming too complacent. We're joined by Nancy Daoud, a private wealth advisor at Ameriprise Financial. Nancy, thanks very much for joining us.
Thank you for having me.
It is interesting. I know the stock market discounts things far in advance and it doesn't really reflect the underlying economy. But it is interesting to see new highs for stocks day after day and signs of a weakening labor market.
Yes, I mean, we certainly have solid earnings growth. We have AI tailwinds. But at the same time, we also have weaker employment trends, and inflation is still here, as you pointed out, and the ongoing trade uncertainties. But it really, a lot of the news now, or the noise, is about the Fed rate cuts. And it's going to be about expectations. You know, if we expect a rate cut, and quite frankly, it's already baked in the market, and we don't get one, that's going to cause the market to react. And if we expect 50 basis points and we only get 25, then that's going to cause a reaction. So it really, unfortunately, is all about expectations and what's already been baked in, and it's sort of a forward-looking type of projection.
People are fond of saying, well, this run-up in tech is not like .com. Back then, we had these companies with no revenue, yada, yada. But do you think there's an element of a bubble in this massive optimism over AI infrastructure spending?
Well, I'm sure there is. There's a lot of competition in that space, and there will likely be consolidation at some point. Some companies are going to soar, and some companies will fall. You know, it will ultimately be who will have the strongest balance sheet and earnings. So that's just normal for any growth spurt. But I do feel that we do see that growth is on the trajectory here.
Are there areas of the market that you're avoiding now? For example, the high-flying Mag 7 names?
No, not in the technology sector, but certainly healthcare is very tricky, and that requires a great deal of selectivity. But we are very much in the trend for financials, utilities, AI, anything related to AI technology. And looking for earnings. That's always the best way to evaluate stocks.
You see the headwinds for healthcare in particular. Well, we got these soaring costs for healthcare. Americans are going to be paying more in health insurance premiums, for example.
Yes, I think it will likely get worse before it gets better, if it gets better. But that's a huge unknown, and there's a lot more darkness there than all of the rest of the new legislation or the new trends that are occurring. With technology, it's a little more predictable. Financial, certainly much more predictable, but healthcare is really tricky at this point.
And give us your thesis on financials. Would you be a buyer of the big US bank stocks, for example?
Yes, absolutely. There's no reason not to. I mean, right now, that's definitely something that we could look forward to. But again, always being selective, not just going across the board as a sector. Selecting stocks is very, very important in times like these. And I do believe that investors have become a little more complacent. They've gotten used to markets being up all the time. Mm-hmm. And that in itself is a reason to be more cautious, although cautiously optimistic. That we always advise our clients, you know, to prepare for the worst, but hope for the best. And being prepared is a very big part of being able to manage volatility or if we do have a big pullback.
And utilities, that's an area you're interested in now. Obviously, they stand to benefit if interest rates come down.
Absolutely. But in addition to that, AI requires a great deal of power. And so utilities and AI sort of go together at this point.
And just on tariffs, I think you touched on this, but markets are, you reckon, pricing in a predictable regime for tariffs, 15% for a lot of trading partners and 30% for China. And you think that companies, well, do companies have a reasonable chance of navigating around that?
Well, so far, it hasn't really shown up. It looks like, for the most part, it's been absorbed by corporations and big business. It hasn't truly hit the consumer yet. And that's obviously the wild card. We have yet to see what will happen if it doesn't happen at all. But if it happens, when will prices reflect the tariffs? And that has not happened yet. And so that's part of the uncertainty that we're still waiting to see the effects of. And everything has a lagging effect. We expect the market to react daily, but that's not quite how it works. A lot of the data is very lagging, especially employment data. That's at least 6 to 12 months lagging. And then we find out it's not even accurate. So, how do you make decisions about that when those are some of the things that are affecting stocks in general?
Nancy, thank you very much indeed. Nancy Daoud, private wealth advisor at Ameriprise Financial.